Hello and welcome to our webinar on passive investing through syndications with Jay Scott. My name is Larissa Greene. I'm with Advanta IRA. And in just a moment, I'm going to invite Jay to join us, and he's going to cover the questions that you should be asking when making these types of investments. And I actually heard this webinar that Jay did with Bigger Pockets, and he talks about how this is a passive investment, but there is some work to be done at the front end of making these investments in the form of due diligence. So he'll be talking about that in just a second. I wanted to give everybody a quick overview about Advanta. Again, my name is Larissa Greene. I am Director of Education and part of the business development team at Advanta. I've been with Advanta for over 10 years now, and I've done everything in regards to self-directed accounts, from opening new accounts all the way through transactions and paying bills on behalf of self-directed IRAs and accepting income. So I am very aware of the process for a self-directed account. And of course, syndication investments can be made with your self-directed IRA or 401k, and even something like a health savings account. So I'll talk about that very briefly in just a second. I do want to make everybody aware that I'm going to keep the attendees muted just to keep the webinar nice and clean for the recording. But if you do have questions, please go ahead and type them into the question box. We will be taking questions throughout the webinar, and then we will also address questions again at the end if there's time. Also, if you're looking for these slides, I do have them uploaded under handouts. So just look at your right-hand navigation. You'll see handouts. You can drop that box down, and the PDF of the slides, that is attached there for you, so that you guys can follow along, print those out, take notes if you want to. I just want to give a little disclaimer. Advanta IRA does not provide any investment advice. We also don't provide legal or tax advice. A lot of the topics that we discuss are based on the rules for self-directing and strategies that we've seen. But if you have a question on how to review the tax status of an investment that you're making, if you're looking to find out if it's a good investment with a good return, those are questions that we cannot answer. You can always reach out to me anyway, and I can refer you to professionals that have helped our clients in the past with those types of questions. We're always happy to connect where we can. But if you do have those questions, again, let me know, but it's probably something I cannot help you with. A little bit about Advanta. We've actually been in business and helping people with self-directed accounts since 2003, so quite a while. We have over $2 billion in assets under management. We only handle private investments. So a lot of times people will say, well, I have a self-directed account, but it's invested in the stock market. That is not what we do at Advanta. What we do is hold private investments, things like real estate syndications. We hold real property. So if you want to buy 123 Main Street in your IRA, but we don't sell any investments. So what we will not do is connect borrowers and lenders, so to speak. But that's a huge plus for you as the IRA holder, because then that means that you can find those investments, and as long as they're within IRS rules, you can make those investments, and we're going to help you get that done and handle the record keeping for those accounts. And like I said, we've been doing this since 2003. I just want to go over just sort of really quickly the types of investments that we see in self-directed accounts. And it's important to know the rules when you're making self-directed investments. I'm not going to talk about that at all today, but if you're interested, I definitely have webinars in our archives and on our YouTube channel that cover the rules for self-directing and the investments that may or may not be allowed in these accounts. But just to give you an idea of what we're seeing on a very regular basis at Advanta, of course, real estate is the #1 investment that we see. So that could be buying real estate and investing with partners. You can also lend money in an IRA, so you can hold a first mortgage, but it might surprise you to know that it could also be a second or a third mortgage. It could be an unsecured note, for example. Remembering that Advanta is not going to give you any advice on these investments. You do have to do your own due diligence, but if that's an investment that you're comfortable with, then it is certainly something you can do in an IRA. Syndications, of course, we're going to talk about today, but we also see things like precious metals, and of course, I'm seeing a larger interest in gold and silver bars and coins. Recently, we also see a lot of foreign currency trading, futures trading, and Something that I don't have on this list that we see growing in popularity is cryptocurrency. So there's a lot of options for you when you're looking at investing through a self-directed IRA. I think the biggest question I get is, well, is there some sort of minimum for these types of accounts? And the answer is no. If you have $1,000 that maybe you're just making your annual contribution and you want to get started because you have an investment plan for that $1,000, that will absolutely work in a self-directed IRA. And I think that's one of the great things about these accounts. You can put your investments to work with the knowledge that you guys have out there in real world situations. So, that's just kind of an overview on what we see. I also like to cover the types of accounts again very quickly, because a lot of times people will say to me, well, it has to be a Roth IRA if I want to self-direct and buy real estate. And actually, if it ends in IRA, it can be self-directed. So it can be a traditional or a Roth. And of course, a traditional IRA is the most common type of account we see. I think that's just very simply because a lot of times people are rolling over from old employers' plans into an IRA in order to get started. And so a lot of times those are going to be pre-tax monies. And so they would go to a traditional IRA. But it can also be an employer-based plan like a SEP IRA or a simple. It can also be a solo 401k. Advanta IRA can help you with that. Any former employer plan qualifies, and I always like to really sort of emphasize former, just very simply because if you're currently employed and currently participating in a plan, it's usually unlikely that the plan will allow you to do an in-service rollover and self-direct a portion of those funds, but you can always check. It's always worth looking into. Every once in a while, we'll see that somebody might be allowed to. Sometimes it's based on the size of the employer and also number of years in service or your age. So there's some factors that go into that. You can also self-direct your health savings account and your education savings account, so also known as a Coverdell. Sometimes people call those ESAs or CISAs. So those can be self-directed as well. We're at a unique time of year right now where you can take those plans, move them over or open them and contribute for the previous year for most of these plans. So if you're looking at just getting started or making last year's contribution, you still have time to do that. In most cases, if you have questions on that, again, feel free to reach out to me. So with that, I'm going to hand control over to Jay. How you doing today, Jay?
I'm doing great. Thanks, Larissa.
Okay, just go ahead and see if you have control there. And while we do that, I just want to remind everybody that I have the question box open. Go ahead and type your questions. As we go, we will address those throughout the webinar.
Awesome. Thank you so much for having me, Larissa. And thank you, everybody, for joining. Today, I'm going to talk a little bit about passive investing through syndication. And my main goal today is to help you answer the question of how do I do due diligence on a syndication? What are the right questions I should be asking? What are the things I should be looking into before allocating any investment in a syndication or picking a specific syndication team to work with? Now, before I get into the how to do it, I want to talk about what a syndication is. So we'll go into how a syndication works and what it is, and then towards the end, I will jump into all the questions we should be thinking about. Okay, a couple disclaimers before we start. First, I am not an attorney. I'm not a legal professional. Please don't rely on anything I say or take it as legal advice. I'm not a CPA. I'm not a tax professional. Please don't rely on anything I say as tax advice or personal financial advice. I'm certainly not trying to sell you anything here today. Yes, we do operate syndications, but there are plenty of amazing syndicators out there. I'm always happy to refer you to the ones I invest with. If you want to learn more about what we do, I'm happy to provide that information. But I'm always here to answer any questions you have. I'll be giving my contact information, and you certainly don't ever need to be working with us for me to be happy to answer questions. I'm a big fan of putting my knowledge out there, just paying it forward because I've had a lot of help from a lot of people over the years. So please don't hesitate to reach out to me in the future if I can help with anything. And then finally, this presentation is purely for educational purposes. This is not investing advice. It's not anything more than that. Final disclaimer, as you'll quickly realize, I'm not a professional speaker. I'm a professional investor, and while I love presenting this information, probably not the most polished speaker you'll ever hear, but hopefully the information I provide will make up for that lack of polish in my speaking ability. little bit about who I am. So I am a former engineer, tech guy. I spent much of my career, about 15 years in Silicon Valley in the tech industry. I spent much of my career at Microsoft. I left in 2008. Since then, I've done a lot in the residential real estate space. I've flipped over 400 houses. I currently own several dozen single-family rentals. I currently focus full-time on multifamily investments. So I have a partner and we have a large team that buys apartment complexes around the country. Over the past 15 years, I've done about $150 million in transactions personally, and I currently live in Sarasota, Florida with my family, my wife and my 2 kids. If you'd like to connect with me, if you'd like to find out more about me, visit my website, hear the podcasts, other podcasts I've been on, feel free to jump on www.connectwithjscott.com, and I will leave it at that. Okay, so like I said, we're going to talk about how I recommend doing due diligence on syndications, what questions you should be asking. But before that, I want to jump into what is a syndication, so everybody has a general idea of what we're talking about when we say the word syndication. So a syndication, let's take an example. So let's say that I want to purchase an apartment building or an apartment complex, or I want to do some other large deal. It could be real estate, it could be outside of real estate. Maybe I want to purchase the Mona Lisa or some other piece of artwork. Maybe I want to purchase $1 million racehorse. While syndication is often synonymous with real estate, there's really nothing stopping us from doing this form of investment entity creation in any asset class. So I'm going to use the example of an apartment building simply because that's what I focus on. But just keep in mind that when you invest in a syndication, it really could be any type of real estate, or it actually could be something outside of real estate as well. So like I said, I want to invest in real estate. I am the person that's putting the deal together. I'm the person that's finding the deal. I'll refer to me and my team as the operators. You'll often hear the term general partner, and the reason for that is because of the entity structure that we use. Typically, we are technically the general partners in the business. So we're not purchasing this apartment complex or this apartment building or whatever the asset is personally. What we're doing is we're creating a business entity. It might be an LLC, it might be a limited partnership, and that entity is buying the asset. That entity owns the apartment complex or the apartment building or whatever that asset might be. And again, I, as the operator, the general partner of the business, me and my team, we own part or all of that business. We are the shareholders in that business. And essentially what we do is we do all the work. We find the deal, we make all the decisions, we do the day-to-day work, we take all of the legal risk if something should go wrong. If we're not fully covered legally, we take all the legal risk. But these deals typically are very expensive. So just to use an example of a deal that I recently closed, we bought a 400-unit apartment complex. The total price with all the renovations we were going to do on the complex was around $46 million. We were able to get a loan against that property for $27 million, so about 75% of the purchase price. But we had to come up with another $19 million to account for our down payment and to account for all the renovation and other costs that would go into this property. So on a $47 million purchase, we had to come up with about $19 million. Now, I've done pretty well in this business. My partner's done pretty well in this business, but unfortunately, we're not in a position where we can do several deals where we put down $19 million of our own money. So that's where the other piece of the puzzle comes in. And that is having somebody or somebody's investors who can come in, they can put in the money, and they can take all the financial risk. Now, when I say all the financial risk, they take the financial risk for the money they're putting in. Typically, the operators or the general partners are also putting in some of their own money on the investor side. So they may be taking some financial risk as well, but all the financial risk is on the investor side of the deal. So in addition to the operators, we have investors. These are the limited partners. These are the people that put in the money in the deal, and they also have an ownership in the business. So the operators own part of the business, they're shareholders. The investors own part of the business, they're shareholders. Actually, the investors typically will own more of the business than the operators. The investors might own 60 or 70 or 80 or 90% of that business. The operators will own 10 or 20 or 30 or 40% of the business. Really depends upon the deal. and those numbers can change, but that's the typical split. But again, the operators are doing all the work, they're making all the decisions, they're taking all the legal risk. The investors are putting in all the money, and they're taking all of the financial risk. And between them, we have this business entity, or this business creation called a syndication. So the syndication is essentially a business entity that owns an asset and is controlled by operators, the people doing the work, and the investors, the people that are putting in the money. So what I'm going to be talking about today is, let's say you want to be an investor in the deal. Let's say you want to be a limited partner. What are the questions you should be asking before you buy into this business, before you become a shareholder in this business, before you invest in this business that owns this piece of real estate? So that's what we're going to be talking about today. So before I get to that, let's talk a little bit about how syndications are regulated, so you have an understanding of what your risk is, and what your exposure is, and what it would take for you to become part of a syndication. First of all, a nice layman's definition of a syndication is anytime you have an investment where passive investors, people who are not making decisions, people who don't have control, people who don't make day-to-day decisions, pull their money into an investment, that's essentially, that's a syndication. So anytime passive investors pull their money into an investment, you've created a security, because those investors don't have day-to-day control, because they can't take their money out whenever they want, because they can't control what's going on in the investment. You've created something called a security. That sale of shares in that security is regulated by the Securities and Exchange Commission, the SEC. Now, all legal syndications are going to register with the SEC, or they're going to file what's called an exemption from the SEC registration. Basically, the SEC says not everybody needs to file a securities offering with the SEC. As long as you follow certain other rules, you can get an exemption, but you still need to file with the SEC to get that exemption. So the first thing I would recommend is, anytime you're thinking about investing in a syndication, ask the operators if they've registered with the SEC, and ask for proof that they have. What you'll typically see with most syndications, at least in the real estate space, is that they'll file an exemption, and they'll have to file a form called a Form D exemption. So always ask your syndicator, your operator, if you can see a copy of that Form D exemption. You can also go right to the SEC database. It's called Edgar, EDGAR, edgar.com, I think, or at least just do a search for Edgar SEC, and you can typically do a search for the name of the property or other key information about who the operators are, and you can find that Form D filing yourself. But always make sure that any syndication that you're considering investing in has been regulated by the SEC, because this is what's going to protect you should something happen with the deal. This is what's going to protect you from fraudulent activity from the operators, or other things that that may cause the deal to go south, but you still have some protection. Finally, let me say that most syndications will require, and this is an SEC requirement, will require that investors fall into one of two categories. Either they're going to have a pre-existing relationship with the operator, and typically a pre-existing relationship means is it's somebody that you know. It's the operator knows this investor. They have an existing relationship, more so than just your Facebook friends, more so than just I happen to hear this guy on a webinar. You and I don't have a pre-existing relationship for all intents and purposes. So for some syndications, the SEC is going to require that the operator have a pre-existing relationship with all of the investors. For other syndications, the SEC is going to require that the investors be what is called accredited. And accredited means that you pass certain financial criteria. And there are two specific criteria that can make you accredited. Number one, if you have a net worth of over $1 million, not including your personal residence. And number two, do you have an annual income of over $200,000 or over $300,000 if you're married? Have you had it for the past 2 years, and do you expect to have that same level of income for the foreseeable future? So when investing in a syndication, make sure you ask the operators, do I have to have a pre-existing relationship with you, and do I have to be an accredited investor? And if the answer is yes to either one, make sure that you truly do. Make sure that you truly have a pre-existing relationship if that's a requirement, and make sure that you're an accredited investor if that's a requirement. You'll often be required to show proof of being an accredited investor, so it's not a good idea to try and fudge your net worth or your income if you're not truly accredited. So that's the basics on how syndications are regulated, and just a couple pre-questions that you should be asking before you become part of a syndication or before you consider investing in a syndication. Finally, let's talk a little bit about how money is made through syndication. So, like I mentioned, the syndication's owned by the limited partners and the general partners. Obviously, both sides are going to need to make money. Nobody's going to invest in a deal without the opportunity to make some return. And general partners aren't going to put their time, their effort, and maybe some of their money into the deal without an opportunity for return as well. So let's talk a little bit about how the money is made in a syndication. It actually looks very similar to any other real estate deal. The first tranche of money is made through cash flow. So maybe, hopefully, but not in all cases, a property is purchased with the intent that it's going to generate cash flow, maybe in year one, maybe starting in year two, maybe starting on day one, maybe never. So you very certainly could invest in a syndication where the business plan is we're not going to make any money for the first 5 years until the property is sold. So good question to ask anytime you're considering investing in a syndication is there going to be cash flow and when does that start? So for most syndications, you can typically expect cash flow, and that's your percentage of the cash the property is generating, either on a monthly, a quarterly, or an annual basis. Most common is quarterly, but some syndicators will pay out on a monthly basis. Occasionally you'll see annual payouts, but typically monthly or quarterly is when you can expect to receive cash flow. The syndicator is going to tell you how much cash flow you should expect to receive. So they may say expect to receive 6% the first year, 7% the second year, 9% the third year, or whatever the numbers are. So we'll talk a little bit about how syndications are presented, but typically there'll be a percentage return in terms of cash flow starting in whatever year the operator indicates that the deal is going to start generating cash flow. Now, limited partners typically are going to make a percentage of the cash flow before the general partners make anything. So the syndicator may say that the limited partners are going to make 6% of their investment back every year in cash flow before the general partners get a penny of that cash flow. That's called a preferred return. So typical preferred returns are 6%, 7%, 8%, somewhere in there. And so you might hear a syndicator say that this particular deal is a 7% preferred return. And so what that means is that if you were to invest, let's say, to make it nice and round numbers, if you were to invest $100,000, you could expect to receive $7,000 a year in cash flow, and that would be before the general partners received anything. Now, over and above that preferred return, if there's additional cash flow, let's say the preferred return 7%, let's say the property actually generates 10% cash flow, so there's 3% extra cash flow above that preferred return, that's where the general partners will typically start making money. So they will split that additional cash flow over and above the preferred return. So it's in the general partner's interest to try and generate at least as much cash flow as dictated by the preferred return, because after that amount, they start making money. So first thing to know is that you will hopefully make your preferred return every year, and then hopefully there'll be some additional money on top of that that you're going to share with the general partners. That's for each year of the deal. Next, when the deal gets sold, so typically a syndication will last 3 years, 4 years, 5 years. I've seen some that last as long as 8 or 10 years. Another question you're going to want to ask your syndicator is how long do you expect this deal to last? But once that deal comes to fruition, once that deal is sold, there's going to be a big bucket of profits, hopefully at the end of the deal. Typically, the limited partners are going to get their percentage of the proceeds first. So if they were to own, let's say, 70% of the deal, then they're going to receive 70% of those profits from the sale. And they're going to receive it in pro rata fashion of how much they invested. So if they invested 1/100th of the total amount in the deal, they'll receive 1/100th of the profit, or at least 60 to 90%, in this case, the 70% of that, again, before the general partners receive anything. General partners are going to receive, on top of their cash flow over and above the preferred return, they're going to receive a percentage of the proceeds from sale as well. And again, if the limited partners own 70% of the deal, that means the general partners own 30% of the deal. And so the general partners could expect to receive 10% of the profits from sale. And that's the bulk of the profit that the general partners are going to generate from operating this property for 3 or 4 or 5 years. In addition, general partners are generally going to collect some fees. These are fees that the limited partners don't collect. And this is typically the way that general partners pay themselves throughout the hold period. Typically, they have overhead expenses like operating expenses for the business entity, accounting fees, legal fees, paying employees. And so for the most part, during that hold time of the investment, the general partners are going to be receiving fees that are going to help them offset some of those costs. Typical fees include what's called an acquisition fee. This is typically 1 to 3% of the purchase price of the property, and this fee is going to come to the general partner at the time the property is purchased. Next is an asset management fee. Typically, this is about 2%, and that is 2% of the gross collected rent every year on the property, or gross collected income, if maybe it's income in addition to rent, and that's going to be collected on an annual basis. And then finally, there's what's called a capital transaction fee, and typically this is a 1 to 2% fee, 1 to 2% of the sale price of the property. That's going to be paid at the time of property sale. So those are the three fees that are common. There are a lot of other fees that some syndicators are going to take. And again, a great question to ask, and I'll have a list of all these towards later in the presentation, but a great question to ask is, what is the list of fees that your team will be taking? Additionally, you're going to get a set of documents that will outline your agreement with the operator. It will outline what you're purchasing, what all the fees are in the deal, what all the risks are in the deal, the business plan for the deal. So you will be getting documentation laying out the entire deal before you become a partner that you'll have to sign. So all that will be laid out as well.
And Jay, we had a question pop up, and I've seen this on syndication deals as well. Are there any tax benefits to individuals investing that have W-2 income? And and we know you're not going to give us tax advice here, but just kind of a general idea. Is there some tax benefits, and would those always be a part of a syndication investment, or is that a question to ask as well?
Yeah. So for most syndication investments, there will be tax benefits. The most common tax benefit is what's called depreciation. And depreciation is what's called a phantom write-off. Basically, it doesn't actually cost any money to get this tax benefit, but you will get it on typically an annual basis throughout the whole period of the investment. A couple of things to say about depreciation. First, for anybody out there, and again, I'm not a tax professional, so don't rely on anything I'm saying, but I can say this pretty confidently. The depreciation benefits that you receive can be used to offset any passive income that you are generating. So for example, typically there's enough depreciation to offset all, and I shouldn't say typically, on our deals there are, on a lot of deals I see there are, that may not be universal, but on a lot of deals there's enough depreciation to at least offset all of the income being generated by the cash flow on the deal you're investing in. So let's say you invest $100,000 in a syndication, you receive 8% cash flow in year one, so that's $8,000 in income. Typically, you're going to get enough depreciation, enough tax benefit in year one to offset that $8,000 completely, so that you would have no tax burden from that particular syndication investment. And typically, you'll have enough depreciation, enough tax benefit in every year to offset all of the cash flow, so that you have no outstanding tax burden from that particular investment in any year that you hold the property. That said, there is one big caveat, and that's depreciation must be repaid at the end of the project. So when that project's eventually sold, let's say in 3 years or 4 years and 5 years, if you took, let's say, $100,000 in depreciation, well, it wouldn't be that much. Let's say you made $8,000 per year for 5 years, and so that's $40,000 in income. Let's say you use the depreciation to offset that $40,000 in income. So you basically had $40,000 of tax deferral benefits during the hold time of that project. At the end of the project, you'd now be required to pay taxes on that $40,000 that you didn't pay taxes on throughout the whole period of the project. And typically, and again, I say typically a lot, but I don't ever like to say anything absolute. Typically, the recapture tax on depreciation is maxed out at 25%, which means that if you're in the top tax bracket, or you're in the tax bracket over 25%, on that $40,000 tax benefit that you have to repay back, you'll pay back 25% or $10,000. So you do get a tax benefit for the hold period of the investment. You're deferring taxes for that entire hold period of the investment, but then you will pay taxes ultimately at a maximum rate of 25%, lower if you're in a lower tax bracket at the sale of the property. Now, a lot of people ask, can you take any extra depreciation? Because I mentioned that you could offset all of your passive income from the depreciation. Can you take any additional depreciation that you get and use it to offset other income? It's going to depend on your situation. Certainly you can use it, or almost certainly you'll be able to use it to offset other passive income that you have coming in. So let's say you own additional rental properties, or let's say you own notes, or let's say you own something else that's generating passive income for you. Typically that depreciation can be used to offset the other passive income that you're generating. Can it be used to offset your W-2 income or any active income that you're generating? Typically the answer is no. But if you are a full-time real estate investor, or a full-time real estate, what the IRS refers to as a real estate professional, then that depreciation can be used to offset your active income. Now, that probably doesn't apply to most people, so I'll leave it at, for the most part, depreciation can be used to offset the syndication income for the period that you're holding the syndication, and it can be used to offset any additional passive income that you're generating in that time period. But again, always remember that you will repay that depreciation when the property is sold. So it's only a tax deferral mechanism. It's not a tax avoidance mechanism. Does that make sense?
Yeah, that was a great explanation. And along those same lines, I had a question pop up here about IRA investing. And so I'm just going to start by mentioning that in case those of you on the call are not aware, there is a time that an IRA, although making a passive investment, could be exposed to a tax called unrelated business income tax. That does happen at times with syndications, depending on the structure of the deal. And so the question that we had pop up is there tax benefits when investing into syndications from an IRA, especially when it comes to the cost segregation study, depreciation part of the syndication deal?
Yeah, and my apologies. I should have remembered my audience when I went through that long discussion just then. That applies to investing out of non-tax benefited accounts. So when you're investing out of an already tax advantaged account like a self-directed IRA, unfortunately, because you're already tax advantaged by investing out of the IRA, you're not going to be able to leverage that additional tax benefit of the depreciation. So I do apologize. I should have realized who I was talking to in this discussion. And yes, if you invest out of your IRA or some other tax advantaged account, unfortunately, you're not going to be able to take advantage of that depreciation. You're also not going to have to recapture it at the end. And as you mentioned, Larissa, there is a tax called UBIT, unrelated business interest tax or something like that.
Yep, income tax, yeah.
Income tax, thank you. That will sometimes apply. And it's something you're going to want to ask your syndicator or ask your CPA, because a lot of times the syndicator is not going to know the answer to whether that's going to apply to your situation. So it's always a good question to ask your CPA or your accountant or your tax advisor. In my experience, I invest a lot in other people's syndications. I invest out of my IRA as well. And very rarely have I been exposed to that UBIT tax, but I don't want to say that it'll never happen, so I would recommend talking to your tax advisor.
And I'll just add to that too, Jay, and say, that when you have an IRA, if it is exposed to UBIT because of the syndication, you'll want to work with a tax professional that is familiar with it, that can help you do some calculations there on anything that might be considered a deduction based on what your IRA might owe. That is a tax owed by the IRA. I always like to clarify, and it does mean that the IRA will file an additional tax form every year in order to pay that tax. So I'm not a tax professional either, so I don't want to go into it too much, but if you have more questions on it or you need a tax professional that can help you with that, please let me know and I can point you in the right direction. Thanks, Jay.
Thanks, Larissa. Okay. So this is what a typical syndication pitch, I'll call it a pitch, might look like. So if you're looking at a syndication, here's the information that might be presented to you, and just to give you an idea of how to decipher what some of this means. Typically, you'll have the name of the property. In this case, this was a deal again that we did a few months ago, and this was the investment overview that we provide to our investors for this deal. And it was Steeples. That's the name of our property. Bar Down Investments, that's my company, is excited to present our latest opportunity. It's an apartment in Houston, Texas. It's a 409 units, so there are 409 units. It's Class B, which means it is not a brand new property, but it is still a relatively high amenity property. Garden style, basically that means low rise, 2 to 3 floor apartment complex in downtown Houston, Texas. Eligibility, that will tell you what the SEC exemption is that the operator is using. Typically, you'll see one of two things here. You'll see either 506B as in boy or 506C as in Charlie. 506B is an offering that is open to both accredited investors and investors that have that pre-existing relationship with the operator. So you don't need to be accredited if you have a pre-existing relationship. 506C offerings are offerings such that you have to be accredited. You have to have the $1 million net worth or the $200,000 or $300,000 per year in income. So always make sure you ask about eligibility. If you're not accredited, if you are accredited, you can invest in pretty much any syndication offering. If you're not accredited, you'll probably be looking for 506B offerings where you have a pre-existing relationship with the operator. Hold period, this is typically how long the operator expects that the deal will be held for. 3 to 5 years is most common. Sometimes you'll see shorter, sometimes you'll see longer. In this case, we had a reason for holding it a little bit longer, but 3 to 5 years is most common. Again, that preferred return is that amount of return that the passive investors are promised before the general partners get anything. In this case, anybody investing less than $250,000 would get a 7% preferred return, so they'd get 7% return on their money before the general partners got anything. Anybody investing more, excuse me, would get a little bit more money. They'd get 8% on their investment each year before the general partners received anything. Oftentimes, there will be some benefit to investors if you invest more money. That threshold could be at $200,000, $250,000, could be higher, could be lower. But always ask if you're interested, is there a benefit to investing more money if you have the ability to do that? That member manager split is that split I was referring to. So in this case, the members owned 80% of the business entity that was investing. The operators owned 20%. And so all profits on the sale of the property would be split 80-20, with 80% going to the investors, the passive investors, 20% going to the operators. And then the expected or the projected returns for this project were between 16 and 20% average annual return, between 14 and 16% internal rate of return. I'm not going to go into what those mean there, but you can do a Google search for each of those to see how those are calculated. Pretty typical returns for the syndication world these days. And then always ask what the minimum investment is. Typically, you'll find a minimum investment somewhere between $50,000 and $250,000. And what I like to say is always ask if you don't meet that minimum, if the operator is willing to make an exception. Oftentimes, operators will make exceptions, especially if you're a first-time investor with that team. So if you can't invest the minimum, always ask if they will make exceptions. But this is what you'll typically see as a typical syndication pitch. Most syndication teams will also do a very detailed 20, 50, 70 pages presentation deck that goes into all the details of the team, the location, the deal, the returns, the risks, basically everything you're going to want to know. Not everybody does this, but when we like to see other teams do this, typically we'll do an hour presentation over Zoom where we'll go over all the details of the offering and take questions from our potential investors. So always ask your syndication operators if they plan to do a presentation and if they'll take questions. If they're not going to take questions live, certainly you want to make sure that there's somebody on the investment team that you can do a phone call with or a Zoom call with, or at least text or email your questions to get those answered. So that's the general overview of what a syndication is. Now let's talk a little bit about the questions that you're going to want to ask and the due diligence that you're going to want to do in order or before investing in a syndication.
And before you go on, Jay,
there are 5 areas that, yes.
I had a few questions pop up. What happens after the hold period?
So after the hold period, the hold period defines how long the property is going to be held. Think of a syndication again, I'm going to use the word typically. For most syndications, think of them as very large flips. So a lot of syndications will be syndicating apartment complexes where the goal is to buy an underperforming apartment complex. When we think about single family flips, we often think about them being in physical distress. So they need renovation, physical renovation. Large multifamily and commercial properties typically need some renovation as well, especially the older ones, but they also need management renovation. So generally, the goal is to buy a property, to overhaul the property both physically and from a management perspective, get better management in there, get higher rents through physical renovations, get management efficiencies and expenses down so that you're increasing the income that the property generates. Large properties, commercial properties, the value of those properties is based off the income they generate. So if you can force that property to generate additional income through increased rents and lower expenses, you can increase the value of the property. So the typical business plan for a syndicator is to buy a property, spend a couple years doing those management and physical renovations, spend a year then stabilizing the property, basically getting new tenants in there, getting a new set of financials for the property that can be relied upon, and then selling the property in years 4 or 5 when you have a big boost in value through your management efficiencies and your physical renovations. So at the end of that hold period, the property is being sold. Just like a flip, hopefully there's a big pot of cash, and then that cash is being distributed back to investors, again, based on that split. Keep in mind, because this is an investment property and it's not a flip, that income, those gains will be taxed as capital gains, not ordinary income. So typically going to be taxed at either 15 or 20%, which is a good bit lower than ordinary income rates, which is what you would see on a flip or other active income type project.
Is there ever a time, Jay, where the general partners might say, well, we want to extend the hold period, or are they going to hold true to that contract no matter what?
So I don't want to speak for other operators, but well, that's not true. I will speak. Generally speaking, operators, their goal is to do what they promise to do. And legally, they have an obligation to do what they promised to do because they have signed a contract with you. They have registered this security with the SEC, including the business plan. And so legally, they have a fiduciary responsibility to investors to make every attempt possible to do what they promised to do. So if an operator says that they're going to hold a property for 3 to 5 years, in my experience, they will try and hold that property for 3 to 5 years. Now, there are things that can happen. So for example, we did a property about a year and a half ago. Our goal was to hold it for 3 to 5 years. The area where we purchased the property has boomed. Values are through the roof. We're in the process of selling that property after a year and a half, and our investors are likely going to far surpass the projected returns. Now, some of them might be unhappy because they were looking to have a 3 or 4 or 5 year hold time. But we made the executive decision, we made the decision as the operators, and we have the right to do this, that because we were exceeding the projected returns by a good bit on this property, that we were going to sell it in less time that we had anticipated. So hopefully most of our investors will be happy about that, but that is something that the operator can unilaterally do if they think it's in the best interest of the investor. Remember, the operator has a fiduciary responsibility. They have a responsibility to try and get the best return to their investors. Likewise, let's say we bought a property that we were looking to hold. Let's say somebody bought a property in 2005 that they were looking to hold for 3 years. 2008 comes along, and maybe that's not a good time to sell because property values, rents have dropped a little bit, values have dropped a good bit. And so the operator may have chosen back in 2008 to not sell in that 3 to 5 year period, but they may have held for 6, 7, 8, 9, 10 years. Typically what we will do is, even if we have an anticipation of selling in 3 to 5 years, we like to model out the financials for up to 8 to 10 years. So if there's a downturn in the market, if we have to hold the property longer because 3 to 5 years turns out not to be a good time to sell, we want to make sure that we can hold it. So do expect that even if the operator says that they're going to hold it for some period of time, if there's some macroeconomic event, or if there's some event in that particular market, or if there's some event with that particular property, it's very possible that the hold period could be extended. And again, That's up to the operator. They make the day-to-day decisions, they make the business plan decisions, but it is required that they're going to be doing that in the best financial um, uh, uh, sense for their investors. So hopefully, if they do make a decision to sell in less or longer period of time, they're doing it because they believe that it's in the investor's financial interest to do so.
And what if an investor wanted to pull out prior to the actual end of the syndication? Is that possible? Is that considered completely illiquid, or how does that work?
So that's a great question. I would ask your syndicator that question. I don't want to talk for other syndicators, but the way we typically do it, and again, I'm not selling anything. I don't currently have any deals that I'm offering, so I'm not trying to get anybody to come to us. But the way we typically will do it is there is no provisions in the agreement to necessarily allow the investors to sell their shares. That said, if the investor comes to us and says, I'd like to do a private sale to another person that I found, or another entity, or some other third party, and they've negotiated that sale privately, we are happy to allow them to change the titling of the investment. And so we will substitute one investor for another. We've had investors who have come to us and asked us as the operators if we will buy their shares. Depending on the situation, we may or we may not say yes. But again, there's no obligation to allow our investors to sell. There's no obligation for us to buy their shares. But in my experience, most operators are pretty reasonable. And if it's a private sale, that there's no reason why they shouldn't allow you to do it. Or if it's a private sale and the operator wants to buy the shares, then it's very possible that they will allow that to happen. So good question to ask the syndicator before investing, especially if you have concerns over needing to sell at some point in the future.
Mm-hmm. Great, thank you, Jay. And one more quick question. We had somebody ask about non-recourse financing as it applies to IRA investments. Does it still apply here? And I'll answer that quickly. It does still apply in the idea that the IRA holder cannot sign for the debt and cannot extend to their personal credit, but it is my understanding that they wouldn't be involved in the financing regardless. Is that correct, Jay?
That's true, and it's actually a little bit better than that. So the reason we call the operators the general partners and the investors the limited partners is the most common structure for these types of deals is what's called a limited partnership, where the limited partners literally have no legal liability, and that includes foreclosure type liability. So yes, an investor can lose up to their entire investment. But an investor will never face legal liability, and they'll never face liability, financial liability over and above their investment. And that is by definition how limited partner works in a limited partnership. And so most syndicators that I know will structure their deals in such a way that the limited partners have no liability, either legal or financial, above their investment. And yes, typically we're using non-recourse loans, loans that are guaranteed by the operators, not guaranteed. And when I say non-recourse and then guaranteed, I know that sounds like a contradiction. Even non-recourse loans, typically you need to guarantee those loans against things like fraud. But if you're invested as a limited partner, even if the operators commit fraud, limited partners have no legal or additional financial responsibility over and above what they've invested.
Great, thank you, Jay.
No problem. Okay, and these slides will be made available. So I know I'm going to have to go through the due diligence piece a little bit quickly, but these slides with the questions that I have here will be made available for anybody that wants to review them. And again, I'm always happy if you want to reach out and get in touch with me. I'm always happy to answer additional questions. But these are the 5 areas of due diligence that I always consider when I'm investing as a limited partner, and I invest in a lot of deals as a limited partner. Again, I invest in a lot of deals out of my IRA. I want to know stuff about the team, the people that are operating the deal. That's actually first and foremost for me. I want to know about the location where the deal is located. I want to know about the property specifically and the business plan. I want to know about the deal. I guess that's the business plan. I want to know exactly what the deal is, what it's being purchased for, how much it's expected to be sold for, and what the team is going to do to get the value from point A to point B. And then finally, I want to know about the risk, both catastrophic risks. So what are the big potential things that could happen, as well as the minor risks that the investing team sees as potentially part of the deal. So some of the questions that I will ask. So let's start with the team. When investing with a new team, a team I haven't worked with before, I want to know what the experience of that team is, how long they've been working together. I mean, if you look at a basketball team, you can have some of the best players in the world on a team together, but if they never played a game together, they may not be great playing together. So you want to see that the teams worked together on deals before. How many deals have they done? How many deals have they done in this asset class? So for example, I've worked with some syndicators who have purchased literally 10,000 multifamily units. Then they decide they want to go into ground up development. I'm going to then treat those deals and that team a little bit differently because they may not have any experience in ground up development, despite the fact that they've done 10,000 multifamily units. So asset class is important. How many deals have they gone full cycle on? This is an important question to ask your syndicator. So I've met plenty of syndicators who own 1,000, 2,000, 3,000 units, but they've never sold any. They've never gone full cycle. They are a year or 2 or 3 years in, they've bought a lot, but they haven't proven that they can actually sell for a profit. So I like to ask my syndicators, have you gone full cycle on any deals? How many deals, how many units, and what did the returns look like? Did you meet your projected returns on those deals? If not, why not? Will they provide references? I like talking to references. So other people that have invested on deals, and then asking them these same questions. Are they doing this full time? Not every syndicator needs to be doing this full time, but I like to know that the syndicators I work with are giving their full attention to the deals that they're doing. What's their communication strategy? So are they going to communicate monthly or quarterly or annually? How do they communicate? Email, newsletters, Zoom calls. So depending on what you're looking for in communication strategy, some syndicators may be better or worse suited to working with you because you may want more frequent communication or even less frequent communication. I get a lot of our investors who complain that I communicate too often, that I send too many emails. So may not be a great fit there. Are the investors, are the operators investing in the deal themselves? So a lot of syndicators will also invest in the deal. They'll have an investment on the limited partner side. We typically try and invest at least 10% of the money we try and raise, we invest ourselves. And so that goes to the point, does the operator, have they aligned their interest with yours? Because if they're investing in the deal as well, they now have more to risk than just their time and their energy. They're also risking their cash. And then if you want to learn more about the roles of each member in the general partnership, who their SEC attorney is, and also you want to know what happens if the head person, whoever's running the company, what happens if they get hit by a bus, or what happens if they decide to retire, or what happens if something takes them away from the deal. What's the succession plan look like? Is there somebody else or some other people that can come and take over? Next, from a location standpoint, why did the team choose this particular market? So big things that I look for in a market are, I want to see population growth, I want to see employment growth, and I want to see wage growth. Those are the big 3 numbers that I look for to determine that a particular market is likely to expand over the next several years, because population expansion and employment expansion and wage expansion is ultimately what's going to drive occupancy and rent values in a particular market. I also want to see what the employment diversity looks like. So I want to see that there are a lot of different industries in the location. If there's a location, if your syndicator is investing in a location that's reliant on one company or one industry, what happens if that industry gets hit, like 2008 with tourism getting hit, or what happens if you invested back in Redmond, Washington, back in the 90s when Microsoft had 80,000 people, but there was no other industry there? What happened if Microsoft had a couple tough years and had to lay a lot of people off? That can destroy the occupancy rates and the rental rates in that particular area. Who is the largest employer in the market? So who should you be considering in terms of who's going to impact your occupancy the most in that market? is there any catastrophic risk? So for example, hurricane risk or tornado risk or earthquake risk, insurance risk, or other catastrophic risks that you should be concerned with. What percentage of the people in this market are renters versus homeowners? That'll give you a good idea of the rental demand. And what's the average age and family status in the submarket? This is important for the very reason that you want to make sure that the makeup of units in that particular property matches what the potential tenants in that market are looking for. If you find out that the average age and family status in a particular market is 23-year-old single people, you probably don't want to be investing in an apartment complex that has mostly 3-bedroom units, because single people don't typically rent 3-bedroom units, especially when they're in their early 20s. So you want to make sure that the demographics in the submarket match the property that you're purchasing. Next, the property itself. When was it built? How many units does it have? What is the vacancy level? So is it 80% occupied when you're buying it or 90% occupied? That gives you a good idea of how distressed the property is. And more importantly is this thing called economic vacancy. I can tell you that a property is 98% occupied. 98% of the units are physically occupied. But if half of those 98% are not paying their rent, if they're in the process of being evicted, the economic vacancy is closer to 50%, meaning you're only getting 50% of the rent that you expect to be getting based on the size of the property and the amount that's being charged. So economic vacancy in many ways is more important than physical vacancy. What percentage of the potential rent is actually being collected? Did you actually walk the property yourself? Not a requirement, but it's always nice to have that option. I like to ask the operator, hey, if I happen to be in Nashville, Tennessee, where this property is located, is it okay? Can I get a tour? And I like the answer to be yes. Even though I don't plan to go to Nashville, Tennessee to see the property, I want to know that it's an option if I wanted to. What's the business plan for the project? How much are you spending on CapEx or renovations? So CapEx is capital expenses. Those are the big ticket items. Things like putting in a pool or a playground or replacing roofs or replacing HVAC systems or upgrading the electrical. So how much are you spending on those big ticket items? Because those are the things that are really going to make an older complex kind of new again and look new again and really revitalize the complex. Who's the property manager? So who's going to be on site managing the property day in and day out? Who are the maintenance people? Who are the leasing people? How many other properties have they done? How many other properties are they managing in the area? You want to see a property management company that has a good bit of experience, but always be careful if they have too many properties in the area. Is there a risk that they're going to take potential tenants from your property and put them into somebody else's property? So always ask about what the density of their business is in that area. What are the projected rent premiums? So how much are rents going to go up after these renovations? And what other properties did you use as comps to determine that the rent's going to go from $1,000 a month to $1,300 a month? $300 a month bump is a big bump. Are there other similar properties in that area, similar to what you're going to renovate to, that are renting for $1,300 a month, or are you just making up that number? And then why is the current owner selling? Just like when we buy single family properties, knowing what the situation of the current owner is will give us some indication of whether or not it might be a good deal. If you find out the seller is selling because actually the seller died and basically the family doesn't want to hold the property any longer, that's probably a better reason than the seller selling because we're at the top of the market and he just wants to take as much profit as he can by selling it at the top of the market. Next, the deal. So again, is this a 506B, meaning you have to have a personal relationship with the operator, or a 506C where you have to be accredited? What's the minimum investment? What's the projected hold time? We've talked about those. How much money are you raising for the deal in total? What are the projected returns? What is that preferred return? Again, that's the amount of cash flow that you're promised before the general partners receive anything. Does that preferred return accrue? If you promise me 6% every year before the general partners get anything, and in the first year I only get 4%, is that additional 2% carried over into year 2? Hopefully it is. What is the operator versus investor split, that 60-40 or 80-20 split? What are the fees? capital call. This is an important one. So if a deal goes south, let's say there's a major economic event and the property is not performing well and the operators run out of money. So most operators are going to have a policy that says they can either ask their investors for additional money and require their investors to put in additional money, or they're going to have a policy, a contractual obligation, not to require investors to put in additional money. So you want to know if there's going to be some potential that you could be required to put additional money in. And especially when investing out of your IRA, you need to be careful, because if there's a chance you're going to have to put more money in and your IRA isn't additionally funded, you can't just take that money out of your personal funds to fund it. You can't commingle your funds. So this is actually even a more important question to ask when investing through your IRA. How often are the distributions? So are you getting cash flow on a monthly, quarterly, or annual basis? And then the last two go to that the tax benefits that we discussed. What are the tax benefits in the deal? And then finally, we have the risks. And the risks are important. What's your biggest concern on this deal as the operator? Have you ever had any issues on other deals? And what did you do about them? Have you ever made one of those capital calls? How would a downturn in the market, a macroeconomic downturn, impact your plan? And what if you had to hold for 8 to 10 years? I know you're planning to sell and you say 3 years, but what if you had to hold for 8 years? Can we still make money? Does the loan support an 8-year hold time, or would you need to get a new loan? Is the interest rate fixed or floating? Does the lender offer loan extensions if the loan runs out? Things like that. Basically, all the details that will go towards what happens if there's some major event, interest rates go up, or it's hard to get a new loan, or whatever it is, so that you know what your potential downside is and how well the operator is mitigating those risks. So those are some of the questions to ask. Again, we'll make these slides available. And if you have any questions, you're welcome to connect with me. If you go to www.connectwithjscott, it will give you a link to connect with me directly through email or through my website, and I'm always happy to answer additional questions.
Great, Jay, thank you for that. And I just want to remind everybody the slides are available as a PDF under handout. So while you're still logged in, you can download them. If you have trouble downloading them, you are welcome to email me, lgreene@advantaira.com. My first initial and last name at advantaira.com, and I'll make sure you get those slides. We did have another question pop up, so I know we're sort of right at the top of the hour here, but we want to make sure we get a few more questions answered. So if you do have another question,
Sure.
Go ahead and get it in the chat box while we finish up here. But Jay, someone is asking, is there a way or a calculation an investor can determine if the deal is less risky to protect the investor going in? So for instance, I heard of a strategy to ensure that the advertised cap rate is around 2 points higher than the interest rate. Hold on, I'm missing the bottom part of this one. Rate of the debt. So is there like a rule of thumb or something like that is kind of what I think they're asking.
So I don't want to get too technical, and if that person wants to reach out to me, I'm happy to have this discussion. I think it's probably beyond the scope of what most people care about. But I will say that cap rate is basically the multiplier in a market. For those that aren't familiar, it's the multiplier that's used in a market to determine what a property is worth. So if a property makes $1 million in income in a year, the multiplier in that market might be 20, which means a cap rate of 5%. So that the property that generates $1 million in that market would be worth 20 times $1 million, or $20 million. If the multiplier were 25, then that property would be worth 25 million. If a property generated $2 million in income with a 20 multiplier, it would be worth 40 million. So cap rate is basically just a way that we value properties. Typically speaking, or not typically speaking, cap rates, the lower the cap rate, the higher values are, because the larger the multiple is. The higher the cap rate, the lower the value is. So what we typically do in the syndication world is we say that we're seeing a certain multiplier or a certain cap rate when we purchase. The question is, what is the operator assuming that the cap rate is going to do between the time you purchase and the time you sell? Do they assume that that multiplier is going to go up so that values are going up, or are they going to assume that that multiplier is going down to be more conservative? Generally speaking, syndicators will assume that that multiplier is going down. some small amount. So let's say we buy with a 4% cap rate. Most indicators will assume that every year that you hold that property, the cap rate's going to go up by 0.1%. So if you hold the property for 5 years, cap rates in that area are going to go from 4% to 4.5%. So the multiplier is going to decrease and the value of properties in general is going to decrease. That's the most conservative approach. We assume that the multiplier is going to go down, that property values in general are going to go down. That's often the result of interest rates going up or demand dropping. And so what I would say is the biggest thing you can do if you want to preserve capital and you want to reduce risk is ask your syndicator, ask your operator, what are your assumptions with respect to the cap rate over the hold period? And if they say that they expect the cap rate to go down over the hold period, that's excessively aggressive. We never want to see that. If they say that they expect the cap rate to stay the same during the hold period, even that's pretty aggressive, especially these days when we expect cap rates to go up because interest rates are going up. So for most indicators these days, they'll say they assume that the cap rate's going to go up or expand every year between now and when we sell. The question is, what's their assumption on how much that's going to be? Is it 0.1%? Is it 0.15%? Most indicators these days are in the 0.1 to 0.15% range. So you want to find that you want to see that your syndicator is assuming that cap rates are going to go up, which means values are going to go down with interest rates over the next couple of years. And you want to see that they're expecting those cap rates to go up at least 0.1% for each year that they're expecting to hold the property. And you want to make sure that they're modeling all of those numbers, all of their projections with that in mind. Now, I'm happy to go into more detail on using cap rates and versus interest rates to kind of forecast risk and other things. But again, I think more than that's beyond the scope of this, and I don't want to bore everybody else.
Thank you, Jay. I appreciate that. I think that was a great explanation for the parties on the webinar today. I don't see any more questions in the chat box, so I just want to thank everybody for joining us. And thank you so much, Jay. I really appreciate it.
Absolutely, my pleasure. And again, if anybody has any additional questions, don't hesitate to reach out to me, send me an email. I'm always happy to answer additional questions.
Perfect. Thanks, Jay, and thank you, everyone. And this recording will be available usually the next day. So if you want to go back and review it, and again, don't forget to download the slides or email me, and I'll make sure you get them. And we look forward to having everybody on our next webinar. And remember that we have them every week, and they're always no cost. Thanks, Jay. We'll talk soon.
Thanks, everybody.